Welcome to the deep dive. I'm truly excited you're joining us today because we're about to embark on a journey that it might fundamentally shift how you see a company you probably interact with all the time.
Mm-hmm.
You probably picture a pizza box, maybe a speedy delivery driver, but today we're not just talking about delicious comfort food. We're talking about Domino's Pizza.
That's right.
And what makes it, well, really a masterclass in not just selling pizzas, but in building this incredibly resilient business model. It's got these surprisingly deep competitive advantages, allowed it to endure and thrive for decades.
Yeah.
Okay, let's really unpack this. You might think of Domino's as, just another fast food chain, but I assure you, beneath the pepperoni and cheese lies a sophisticated, almost counterintuitive business engine.
That's precisely it. What's truly fascinating here is how a seemingly simple everyday product can hide layers of strategic genius. Our mission for this deep dive is really to cut through the noise, to go beyond the crust and truly understand what makes Domino's tick, its underlying business quality, the true strength of its competitive defenses, its fortress, and its financial resilience that allows it to, punch above its weight.
Mm-hmm.
We're looking beyond just surface-level observations to explore whether this business truly has an enduring quality worth understanding, and perhaps more importantly, what that implies for its future.
That's a massive question. And before we dive into the details, just a quick note for our listeners on all the resources that accompany this analysis.
Exactly. This discussion, it's a deep dive, but the full detailed research report with all the data, that's available as a PDF. It's really the perfect companion document for those who want to do their own due diligence.
And the link for that is right at the top of the description below.
And for those who want to act on these ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description as well, right?
That's right. All the resources are in the description. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel.
Perfect. Housekeeping is done. So let's get into it. Pillar number 1, the business model. So let's start with the very foundation of Domino's. We all know they sell pizza, right? But how do they actually make their money? And what makes their model so resilient in, a hyper-competitive market?
It's deceptively simple, and that simplicity is actually a core strength. Domino's Pizza, Inc. primarily operates on a highly profitable capital-light franchise system.
Okay.
This is absolutely crucial to understand. Over 95% of their more than 21,000 global stores are independently owned and operated by franchisees.
95%. Wow.
Think about that for a moment. This structure is brilliant because it minimizes the parent company's direct capital expenditures and direct operational risks.
Right.
Imagine the staggering amount of capital it would take to build, staff, and maintain 21,000 stores globally. Instead, Domino's acts more like a landlord and a key supplier to this massive global network of independent entrepreneurs.
Landlord and supplier. Okay.
Yeah, the primary revenue from these stores comes from ongoing royalties. Typically, it's about 5.5% of weekly gross sales, and also advertising fees that fund those ubiquitous, impactful marketing campaigns we all see.
So if I'm hearing you right, they're not really in the business of slinging pizzas themselves in most locations. They're more in the business of enabling others to sling pizzas.
Exactly.
Which is a genius move for capital efficiency. But what's the real game changer that turns this into a true competitive fortress beyond just franchising? I understand there's a second equally crucial revenue stream, right? The supply chain.
That's where the supply chain becomes the unsung hero, the strategic weapon you alluded to. It's not just a revenue stream. It's really the core of their competitive advantage. The supply chain operations are a truly significant part of the business, accounted for approximately 60% of total revenue in the third quarter of 2024.
60%.
Yeah. This segment manufactures fresh pizza dough, and it distributes a vast array of ingredients, supplies, equipment, pretty much everything, to nearly all U.S. franchisees and many international partners, too. Now imagine if every independent Domino's store, all 21,000 of them, had to negotiate their own flour, cheese, pepperoni prices individually.
Chaos. Costs would be all over the place.
Exactly. Their costs would skyrocket, their quality would vary wildly. The insight here is how Domino's, through its centralized, vertically integrated supply chain, creates an enormous cost advantage and ensures consistent quality that, frankly, no small competitor can match.
Right.
This dual-purpose product quality and consistency and powerful economies of scale is incredibly potent.
And those few company-owned stores, they're not just regular retail spots, are they? I've always wondered about those.
Not primarily, no. While they do generate direct retail sales, their more important function is as strategic laboratories or, innovation hubs.
Ah, okay. Test kitchens?
Kind of. These locations are critical testing grounds for new products.
Yeah.
Yeah, like a new chicken wing recipe or a dessert item. But also for technologies, like maybe an AI-driven ordering system or new kitchen automation.
Interesting.
And for operational procedures, perhaps a new way to route delivery drivers or manage inventory. They test these innovations in a real-world, controlled environment before they are rolled out to the broader franchise system.
So they de-risk it for the franchisees.
Precisely. It allows Domino's to refine, iterate, perfect new initiatives without burdening their independent franchisees with untested concepts. Reduces risk for the whole network. They are the R&D arm, really, ensuring innovation translates into efficiency and improved customer experience system-wide.
That makes so much sense. It's like a perfectly calibrated, constantly improving machine. You mentioned a flywheel ecosystem earlier. Can you elaborate on how these seemingly distinct segments, franchising and supply chain, actually reinforce each other, like in a continuous cycle?
Certainly. Think of it as a dynamic, continuous cycle of growth and efficiency, a true self-reinforcing loop. Here's how it works.
Okay.
First, successful store growth, primarily driven by that attractive capital-light franchise model, directly increases the demand for the supply chain's products. More stores mean more dough, more cheese, more toppings needed. Simple, right?
Right. Basic supply and demand.
Second, as the supply chain scale increases due to this rising demand, it benefits from even greater purchasing power. They can buy ingredients in truly massive quantities, leading to even lower input costs to the franchisees.
That's the key link.
That's a crucial link. These lower costs directly enhance franchise profitability, making the business more attractive and, frankly, more lucrative for them.
Which means?
And finally, that increased franchisee profitability, in turn, strongly incentivizes them to open even more stores or invest more in their existing ones.
Ah, the flywheel spins faster.
Exactly. It's a symbiotic relationship where each part strengthens the others, creating a powerful, virtuous cycle that generates both growth and efficiency.
And what about the people in the system? I heard something quite remarkable about how they staff their leadership, which sounds like it plays right into this flywheel effect.
This is truly unique and, in my view, one of the most powerful and often overlooked aspects that strengthens the flywheel. Over 95% of U.S. franchisees began their careers as part-time pizza makers or delivery drivers.
That's incredible, seriously.
Seriously. Think about the implications of that. The people who own and operate these independent businesses have an intimate, ground-level understanding of the company's culture, its operational standards, the daily challenges, everything.
They've lived it.
They've lived it. This deep-seated internal promotion system ensures incredibly strong alignment between corporate strategy and local execution. It significantly reduces execution risk across this vast, decentralized network because the people running the stores literally grew up within the system.
Yeah.
And it provides a powerful, tangible incentive for employees to stay, grow, aspire to ownership within the system. Fosters a deep sense of loyalty and entrepreneurial ambition. It's a career path that genuinely starts from the ground floor up.
That's incredible. It's a genuine career path, almost like a vocational university for pizza entrepreneurs. So at its core, Domino's sells pizza, but you're saying its real business is something else entirely.
That's right. While the product they sell to the end consumer is pizza, the true business, the enduring core, is franchising and logistics.
Franchising and logistics, okay.
This distinction is vital for understanding its remarkable endurance. Domino's profits from the timeless human desire for convenient, affordable, and consistent food. Pizza isn't a fad, it's a staple of the quick-service restaurant industry.
Right, it's not going anywhere.
Exactly. Their relentless focus on value, speed, digital accessibility offers a proposition that transcends economic cycles and passing food trends. Think of how many food fads have come and gone: kale smoothies, artisanal toast, poke bowls. Pizza, particularly affordable fast pizza, endures because it fulfills a basic human need for comfort and convenience. It's a timeless need being met with a highly optimized, efficient system.
And that system has leaned heavily into technology, becoming what some observers have called a tech company in disguise. How pivotal has that digital transformation been to their current success and future resilience?
It's been absolutely central to their modern success and durability, arguably one of their most strategic long-term investments. Domino's recognized the global shift toward digital commerce and food delivery very early on, way before many competitors caught on.
They saw it coming.
They really did. They didn't just adapt. They pioneered. They invested heavily in transforming their infrastructure from a traditional phone and walk-in model to a digital-first ecosystem. Today, over 85% of their U.S. sales originate from digital channels.
85%.
Yeah, they built a formidable proprietary technological backbone. You've got their Domino's Polarized point-of-sale system, a highly rated mobile app that consistently ranks among the top food apps.
I've used it. It's pretty slick.
It is. And their innovative Anywhere platform, which allows customers to order from a multitude of devices, smartwatches, smart TVs, you name it. This digital ecosystem isn't a fleeting advantage, it's a durable asset. It deepens the customer relationship, provides invaluable data for continuous improvement, and will remain central to the business for the foreseeable future. It's a significant barrier to entry for anyone trying to catch up digitally.
So this brings us perfectly to the idea of an economic moat, the competitive fortress that protects Domino's. We've talked about the business model. Now, what are the primary, most powerful sources of this moat? What truly keeps competitors at bay?
Domino's possesses a formidable economic moat, right? A set of structural advantages protecting its profitability and market share. This moat is primarily constructed from two very powerful sources.
Okay.
First, cost advantages. These come from its enormous scale and that vertically integrated supply chain we talked about.
Right.
And second, intangible assets, primarily in the form of a globally recognized, incredibly powerful brand.
Scale and brand.
Scale and brand. And these two are then powerfully reinforced by emerging network effects within its technology platform and the unique dynamics of its franchise relationship.
Let's break down those cost advantages first. Where do they really come from, and how do they manifest in a way that competitors simply can't replicate?
Okay, the most powerful component is the cost advantage from its vertically integrated supply chain. With over 21,000 stores globally.
Just mind-boggling scale.
It is. Domino's leverages immense, almost unimaginable purchasing power. Consider that.
Yeah.
They can procure ingredients like flour, cheese, tomatoes in quantities that allow for deep volume discounts. They also manufacture their own fresh dough, which is a massive differentiator. Allows for consistency and cost control that individual restaurants or smaller chains simply cannot match.
Right.
This scale advantage is then complemented by what's called a fortress strategy, basically building high store density in key markets.
Putting stores close together.
Exactly. More stores in a smaller geographic area means incredibly fast delivery times because the pizza has less distance to travel and, crucially, a lower cost per delivery as drivers can complete more orders in less time. Makes them incredibly efficient and hard to beat on speed and price in their core markets.
And the intangible asset is the brand itself, I imagine. But brand can be nebulous. What specifically about the Domino's brand acts as a moat?
Absolutely. As the largest pizza company in the world by both sales and store count, Domino's enjoys a rare and valuable asset, top-of-mind awareness with consumers globally.
Just pops into your head when you think pizza delivery.
Pretty much. And this isn't just about a logo. It's about trust, familiarity, a predictable experience. This powerful brand position wasn't built overnight or cheaply. It's the result of decades of consistent service, that promise of a hot pizza delivered quickly and massive, sustained advertising campaigns, largely funded by the franchisees themselves, remember?
Right, through those ad fees.
Exactly. That brand recognition acts like a magnetic pull for customers. When you think pizza delivery, Domino's is often the first name that comes to mind. That significantly reduces customer acquisition costs and boosts repeat business. It's a powerful psychological barrier for competitors.
It sounds like a strong foundation, but can you give us a concrete example of this moat in action? How does this structure actively repel competition, creating a truly durable advantage?
A prime example, and one that I think is often overlooked, is the structure of its supply chain profit-sharing agreement with franchisees.
Okay, profit sharing, how does that work?
Well, while franchisees are independent business owners, they are strongly incentivized to source all their supplies from Domino's corporate through their supply chain system. And here's the genius part. The company shares 50%, half of its distribution profits with franchisees who commit to purchasing everything from the system.
Wow, that's a direct incentive. So they're literally sharing the wealth to keep everyone in the family, locking them in.
Exactly. This arrangement is a masterclass in moat reinforcement. It makes the official Domino's supply chain the most economically rational, indeed the only economically rational choice for the franchisee.
Makes sense. Why go elsewhere?
Right. They get high-quality, consistent ingredients at the best possible price, and they share in the profits from that very efficient supply chain. This effectively locks them into the system and, crucially, starves potential third-party suppliers of the volume they would need to compete.
Cuts off their oxygen.
Pretty much. A rival supplier simply cannot offer a better price because it lacks the monumental scale of Domino's. And it cannot achieve that scale because it cannot win the franchisee's business away from this deeply embedded incentive system. It's a powerful, self-sustaining, competitive loop, kind of like golden handcuffs that benefit both parties and starve the competition.
So this moat isn't just static, it's dynamic. What evidence do we have that Domino's moat is actually widening in today's competitive landscape, or could it be at risk of narrowing?
The evidence suggests Domino's economic moat is indeed widening. You can see this clearly in market share trends. In the highly competitive U.S. market, Domino's commands a staggering 42% of sales among the top national pizza chains.
42%, that's huge.
It's nearly double its closest competitor, Pizza Hut, which has 23%. But what's even more important is that this share is not just dominant, it's growing. The company gained nearly a full percentage point of the U.S. QSR pizza market in 2024 alone.
In 1 year. That's impressive in a mature market.
It really is. In a market like U.S. quick service restaurants, gaining a full percentage point of share is a significant achievement. It indicates their competitive advantages are not just durable, but are actively allowing them to take ground from rivals. It's a clear sign of strength.
And how is technology playing a role in widening that moat? You mentioned their proprietary digital ecosystem.
Right. The proprietary digital ecosystem, processing over 85% of U.S. sales, creates a powerful data network effect.
More data, the smarter it gets.
Exactly. With each order placed through their app or online platform, Domino's gathers more data customer preferences, peak ordering times, delivery routes, product popularity, even how long someone spends on the app before ordering.
Everything.
Pretty much everything. This data is then used to refine marketing strategies, improve operational efficiency at the store level, enhance the customer experience through personalization. The more customers use the platform, the smarter and more efficient the entire system becomes, further distancing it from competitors who lack this scale of proprietary data and the ability to integrate it directly into their operations.
It's a continuous improvement loop fueled by data.
Precisely.
Yeah.
And it's a very difficult advantage to replicate.
Speaking of widening the moat, I found it fascinating how they recently partnered with Uber Eats. On the surface, that might seem like a risk, right? Giving up their direct customer relationship, how does that strategically widen their moat instead of narrowing it?
That's a perceptive observation, and it highlights a pragmatic and strategic move. While third-party aggregators could absolutely be seen as a threat, potentially disintermediating that direct customer relationship.
Yeah, that's the worry.
Domino's has effectively turned it into a moat-widening opportunity. This partnership allows Domino's to tap into a massive new pool of customers who are loyal to aggregator marketplaces like Uber Eats, rather than necessarily using specific restaurant apps.
Reaching people they wouldn't otherwise reach.
Exactly. This incremental volume, which management estimates could generate an additional $1 billion in sales over time, is then funneled through Domino's own hyper-efficient supply and delivery system.
Using their existing infrastructure.
Right. It leverages their existing assets, their central kitchens, their proprietary dough, their in-house delivery drivers to capture new demand without having to build a separate, redundant delivery infrastructure. It's a smart, tactical move that feeds their core strengths, reaching customers they might not otherwise, and therefore widens their market reach without compromising their fundamental operational efficiency.
Fascinating. Okay, now, let's switch gears and put ourselves in the shoes of a customer or an employee. We call this our Scuttlebutt simulation, gathering direct feedback from the trenches. What does direct feedback tell us about customer loyalty? Is it passionate love for the pizza, or more like a reliable, convenient friend?
Direct feedback from customers suggests that the brand is reliably liked for its value and convenience, rather than passionately loved for its product quality.
Okay, liked, not loved. Interesting.
Yes. Their Net Promoter Score, or NPS, which measures customer experience and loyalty by asking how likely customers are to recommend a company, is 18.
18. That's not amazing, is it?
It's considered a neutral score that reflects a mix of experiences with 50% promoters who like it, but a notable 32% detractors who, well, don't. However, and this is crucial, it's counterbalanced by a very strong customer loyalty score of 77%. That indicates a high degree of repeat business.
So they complain, but they come back.
Pretty much. While people might not rave about the gourmet taste, they keep coming back consistently because Domino's reliably delivers on its promise. Speed, affordability, convenience.
Got it.
In the American Customer Satisfaction Index, or ACSI, Domino's edges out its direct competitors, like Pizza Hut and Papa John's, reinforcing its position as a preferred choice in its category. It suggests that in the quick service pizza segment, consistency and convenience often win over culinary artistry.
And speaking of customer perception, we absolutely have to talk about that legendary Our Pizza Sucks campaign from 2009. For newer listeners, what was that and why was it such a masterstroke in rebuilding trust and brand?
Oh, it was unprecedented.
Right.
An act of corporate humility and brutal honesty.
Yeah.
And a marketing masterstroke. In 2009, Domino's publicly admitted their pizza wasn't great, a shocking admission for any major brand.
Ballsy move.
Totally. They then launched this highly transparent campaign showing customers into their test kitchens, responding to harsh feedback on social media, and ultimately reformulating their entire recipe. The insight here is that in an age of skepticism, brutal honesty can be your most powerful marketing tool.
Right.
It didn't just rebuild trust, it created a powerful narrative of a company willing to listen, be vulnerable, fundamentally change based on customer feedback. It resonated deeply because it felt authentic, and it earned them significant goodwill.
Yeah, I remember that. It really worked.
It did. However, despite that, a review of more recent customer complaints, particularly with organizations like the Better Business Bureau, reveals recurring issues at the store level.
Oh, like what?
Things like incorrect orders, cold food, poor handling of customer service issues, especially around promotional offers, and, interestingly, third-party delivery experiences.
So even with a strong brand built on transparency, there are still operational cracks that consistently appear.
Yes, unfortunately. These complaints underscore the inherent operational challenges in managing a large, decentralized franchise system of over 21,000 stores.
It's hard to control quality everywhere.
Extremely hard. While customers are loyal to the convenience and value proposition, this loyalty may be brittle if execution at the individual store level falters consistently. It's a reminder that even the strongest brand relies heavily on the consistent day-to-day delivery of its promise. A great national campaign can attract customers, but poor local execution can just as quickly drive them away.
That leads us neatly to the employee perspective, which I hear is quite polarized. What's the sentiment on the ground? How do the people making and delivering the pizzas feel about working for Domino's?
Employee sentiment is indeed highly polarized, and it appears to be almost entirely dependent on the quality and financial health of the specific franchisee.
So it varies wildly from store to store.
Exactly. And this is a significant vulnerability in the company's fortress, as the health of the system is only as strong as its weakest link. On the positive side, around 68% of employee reviews on platforms like Comparably are positive.
Okay, that's majority positive.
It is. Yeah. Many employees, particularly in well-managed stores with supportive owners, praise the camaraderie among colleagues, the flexible schedules, and the good income potential from tips, especially for delivery drivers.
Right, tips can add up.
They can. And crucially, that clear path we discussed earlier, from part-time delivery driver to multi-store franchisee, that's a powerful, tangible incentive, fosters loyalty and ambition. It offers a real entrepreneurial ladder.
Yeah.
Corporate employees also generally report a challenging, rewarding, and transparent work culture. They appreciate the clear mission and growth opportunities.
But there's a darker side to that sentiment, isn't there? What are the common complaints?
Unfortunately, yes. A substantial number of negative reviews reveal a darker side, often reflecting what frontline employees perceive as a squeezing franchise model.
Squeezing?
Meaning many feel overworked and underpaid, often blaming their specific franchisee for cutting corners to save costs. They describe working in skeleton crews, insufficient staff, and facing intense pressure from managers who are themselves under financial strain to meet sales targets and cost controls.
Pressure flows downhill.
Exactly. This friction between the franchisee and the employee is a direct cause of some of the service inconsistencies that customers complain about, like slow deliveries or incorrect orders.
And this internal friction sounds like it could have broader implications for the business. If the employees are stressed and feeling squeezed, what happens to the customer experience and ultimately the brand?
It absolutely could have profound implications. This is a critical pressure point that bears close watching. If economic pressures on franchisees mount from persistent rising food costs, minimum wage hikes, or even new aggregator fees, this internal friction could intensify.
Right.
That would likely lead to higher turnover among staff, difficulty recruiting new talent, and critically, a systemic decline in service quality across the entire network. This would directly threaten the brand's core promise of reliability and speed.
Which is everything for them.
It's a major part of its competitive advantage and customer loyalty. If the customer experience consistently deteriorates, even the strongest brand can suffer long-term damage, threatening that entire self-reinforcing flywheel we talked about.
Okay, we've unpacked the core business model, dissected its competitive advantages, and even looked at it from the customer and employee perspective. Now let's talk about the people at the helm and the financial underpinnings of Domino's. Who's leading the charge and what's their philosophy?
The company is currently led by CEO Russell Weiner. He's a truly long-tenured executive, joined Domino's back in 2008.
Been there a while.
Yeah, he was in fact a key architect of the brand's celebrated pizza turnaround campaign in 2009 that we just discussed.
They are pizza sucks guy.
Well, involved anyway. Heavily involved, yes. Having served as Chief Marketing Officer and Chief Operating Officer before becoming CEO in 2022, his understanding of the business is exceptionally deep and holistic. He's not just a new face. He's intimately familiar with the operations, the brand history, the intricacies of the franchise system.
So he's seen it all, essentially. What's his leadership philosophy, and how does that impact the day-to-day and strategic direction of the company?
His public statements and strategic initiatives reveal a very clear, long-term, owner-oriented philosophy. He champions transparency, as we saw with the 2009 campaign, and a strong focus on empowering frontline workers. He famously captures this in the motto, if you don't make, bake, or take it, you support those who do.
I like that. Focus on the front line.
Exactly. It reflects a genuine understanding that the success of the corporate entity flows directly from the success of its franchisees and their employees. His current Hungry for More strategy is pretty straightforward. Drive more sales, more stores, and more profits annually. Simple, measurable goal for shareholders.
Okay, more. Got it.
Critically, he emphasizes growing profitable order counts rather than relying solely on price increases. This is a hallmark of a rational leader focused on sustainable, long-term market share gains over short-term margin expansion. Understands that value and volume are key in the QSR space.
That sounds like a very disciplined approach. How does that translate into their capital allocation track record? Where do they put their money, and what does that tell us about their priorities?
Management adheres to a very disciplined and rational capital allocation framework. Priorities are logical and explicitly shareholder-friendly. Their first call on capital is always reinvesting in the core business projects that fortify their moat and enhance returns.
Makes sense. Sharpen the saw.
Exactly. This is evident in sustained spending on technology to improve the digital customer experience, refining the app, upgrading PLC, and on supply chain automation, like new dough manufacturing equipment, to drive efficiency and lower costs. For instance, CapEx in 2024 was around $113 million. Clear sign of this consistent commitment.
Okay. And what about acquisitions? Do they go on a buying spree, chasing growth through M&A?
Wisely, no. The company has largely avoided large, empire-building acquisitions that, let's be honest, often destroy shareholder value by diverting focus and trying to integrate disparate businesses.
Yeah, that happens a lot.
Their focus remains squarely on the core pizza business. Any smaller strategic investments, like their joint venture in DPC-Ltd, are highly targeted. They appear to be technologically focused or aimed at enhancing their existing model, rather than diluting the core business. This disciplined M&A strategy reinforces their commitment to leveraging their existing strengths.
So they don't seem to be distracted by shiny new objects. And for shareholders, how do they return excess capital? What's their track record there?
Domino's has an excellent track record of returning excess capital to its owners. They pay a consistently growing dividend.
Always nice to see.
Which is a good sign of a stable, cash-generative business. Beyond that, they have been an aggressive repurchaser of their own stock. In Q1 2025, they bought back $50 million of shares, had a remaining authorization of over $760 million for future buybacks.
Wow, significant buybacks.
Yeah. This disciplined approach has led to a meaningful reduction in the share count over time, which benefits existing shareholders by increasing their proportional ownership of future earnings and free cash flow without them having to lift a finger. It's a very shareholder-friendly approach once internal high-return opportunities are funded.
This all sounds incredibly rational. What about their debt levels? I understand they carry a significant amount of debt. How does that fit into this rationality test? Isn't high debt risky?
That's a crucial point, and it's where sophisticated capital structure comes into play. The capital allocation strategy is, indeed, overwhelmingly rational and shareholder-friendly. Prioritize fortifying advantages, fund those, then return the prodigious free cash flow.
Right.
Now, regarding the high debt level, net debt to EBITDA ratio was 4.9x in Q1 2025, historically hovering between 5x and 6x. That might look risky in isolation.
Yeah, 5-6x sounds hot.
It does. However, for a business with such extreme stability and predictability of its franchise-based cash flows, this level of debt is not necessarily a sign of recklessness. It's more a deliberate, sophisticated capital structure choice.
How so?
Think of it like a landlord with very predictable rental income. They can take on more debt because they know the cash flow is coming in reliably. Domino's management has rationally chosen to employ this leverage to repurchase shares, thereby magnifying returns on equity and increasing per share value for the long-term owner.
Using debt to boost returns per share.
Exactly. It's a calculated risk, but one backed by very stable, almost utility-like cash flows. Makes it a powerful tool for shareholder value creation, provided those cash flows remain stable.
That brings us to the financial fortress itself. How consistent are their profits, and what do the key quality ratios tell us about the underlying health of this business?
Domino's is a highly reliable and consistent earnings machine. The franchise and supply chain model has proven its ability to generate steadily growing profits through a full decade of varied economic conditions. Demonstrates resilience, pricing power, even through recessions or inflation.
Okay.
For instance, looking at their financial data, total revenue grew consistently from about $2.2 billion in 2015 to over $4.7 billion in 2024.
More than doubled.
Yeah. And in the same period, net income grew from around $193 million to $584 million. That consistent growth across different economic climates is a clear indicator of a robust business model generating predictable and growing profits.
And those numbers really show a clear upward trend, but beyond the absolute numbers, what about the quality ratios? What's the single most impressive metric you see that truly signals a superior business?
The most impressive metric, without a doubt, is their return on invested capital, or ROIC.
Okay, the efficiency metric.
Exactly. It tells you how efficiently a company uses the capital invested in its business to generate profits. Now, different sources calculate it slightly differently, but all conclude it's extraordinarily high. Recent figures range from, say, 43% to over 80%.
Whoa, 40 to 80%. That's massive.
It is. And here's why it's so impressive. Critically, their ROIC consistently dwarfs their weighted average cost of capital, or WACC, which is around 8.8%.
So cost of capital, 8.8% return.
Way
higher.
Way higher. Think of WACC as the cost of the money the company borrows or raises from shareholders. If Domino's is paying roughly 8.8% for its capital, but generating returns of over 40%, historically even higher on that capital, that massive spread, currently over 30%, 5-year average around 67%, that is the clearest quantitative evidence of a superior business with a strong economic moat.
Huge value creation.
Immense value for every single dollar of capital invested, year after year. It's a hallmark of a truly high-quality enterprise.
So they're not just making money, they're making a lot of money very efficiently with the capital they deploy. Powerful combination. What about free cash flow conversion? How much of that reported net income actually turns into real spendable cash?
That's a fantastic question, and it's a mark of true business quality. Think of net income as your salary on paper. Free cash flow is how much you actually have left in your bank account after bills and investments. It's the real cash.
Right. What you can actually spend or reinvest.
Exactly. Domino's demonstrates excellent earnings quality in its free cash flow conversion. In fiscal 2024, Domino's converted approximately 88% of its $584 million in net income into $512 million of free cash flow.
88%, that's very strong.
Very strong result. Indicates the vast majority of their accounting net income translates directly into actual cash available to owners, which they can then use for dividends, buybacks, or further reinvestment. It's incredibly efficient. No phantom earnings here, just solid cash generation.
And finally, the balance sheet strength, or as you noted earlier, the potential lack thereof, given the leverage. How significant is this as a point of caution?
Indeed, the balance sheet is the primary point of caution. As we mentioned, the net debt to EBITDA ratio stood at 4.9x in Q1 2025, historically hovering in the 5x to 6x range.
Still seems high, even with stable cash flows.
It is relatively high. For a business with such stable and predictable cash flows like Domino's, derived from its franchise and supply chain model, this level of debt is generally considered manageable. It's that calculated choice to amplify shareholder returns we discussed.
Right.
However, it does reduce the margin of safety in the face of an unforeseen catastrophic event, like a truly severe, prolonged economic downturn or a black swan event that disrupts their cash flows significantly.
Less wiggle room.
Exactly.
Right.
While they've proven resilience, a highly leveraged balance sheet means less flexibility if the unexpected happens. It's a factor that must be monitored closely, even with their robust cash generation. It introduces a level of financial risk not present in unleveraged businesses.
So we have a deep understanding of the business quality and its financial underpinnings. We know it's a high-quality, high ROIC business. Now, let's talk about the big question for many of our listeners. What about the price? Is this a good time to consider Domino's from a valuation perspective?
An analysis of current valuation multiples relative to their historical ranges suggests that, well, while Domino's is rarely cheap in an absolute sense, high-quality businesses rarely are.
True. You pay up for quality, usually. But the current price is not demanding for an asset of this quality and resilience. It appears to be a fair, perhaps even slightly attractive, entry point. Fair to slightly attractive. Okay. Can you give us some specific numbers to illustrate that? What do the common valuation multiples tell us?
Certainly. Let's look at a couple of key multiples. The current trailing 12-month, or TTM, price-to-earnings ratio stands at approximately 25.6x.
25.6, okay.
Critically, this is comfortably below its 5-year average of roughly 29.7x and its 10-year average of about 31.4x.
So cheaper than its recent history on a PE basis.
Correct. It means the market is currently valuing each dollar of Domino's earnings at a lower multiple than it has on average over the past 5 or 10 years. Similarly, the price-to-free cash flow ratio, looking at actual cash, is around 27.1x. That's also well below its 10-year median of about 33.5x.
Same story on free cash flow. So it's a high-quality business consistently generating significant returns on capital, yet it's trading at a discount to its own historical valuation. That feels counterintuitive. Why might that be the case?
That's the interpretation, and it leads to our aha moment regarding valuation. Based on a deep analysis of its exceptional quality, widening moat, rational management, the current valuation appears to represent a fair to slightly attractive entry point for a long-term investor.
Right.
A business that can consistently generate ROIC above 40%, as Domino's does, inherently deserves to trade at a premium multiple because it's so efficient at converting capital into profit. The fact that it's currently trading at a discount to its own historical valuation, despite the business fundamentals remaining robust and even improving in some areas, well, it suggests the market may not be fully appreciating its long-term durability, the strength of its core business model.
Maybe focus too much on the short term.
Perhaps. Maybe overly focused on shorter-term sales fluctuations or competitive headlines, overlooking the underlying strategic power.
That brings us to growth and, importantly, the permanent risks that could truly impair this business over the long term. Let's start with the upside. What's the single most important identifiable growth engine for Domino's going forward?
The single most important identifiable driver for future earnings growth appears to be the strategic expansion into third-party aggregator platforms, specifically led by the partnership with Uber Eats.
Ah, the Uber deal. That's the big one.
It seems to be. This is a pragmatic move designed to capture a new segment of customers, those loyal to aggregator marketplaces, rather than necessarily ordering directly from specific restaurant apps.
Makes sense. Meet customers where they are.
Exactly. Management has even quantified this opportunity, suggesting it could generate an incremental $1 billion in sales over time simply by making their product available to a wider audience through these popular channels.
$1 billion incremental.
Significant.
Very significant. And this strategy powerfully leverages Domino's existing highly efficient operational and supply chain infrastructure to service this new source of order volume. Represents a tangible growth vector. While continued international store expansion remains an important secondary driver, the aggregator play, particularly with Uber Eats, is seen as the primary catalyst for near to medium-term growth.
So that's the primary tailwind, bringing new customers into their highly efficient system. Now let's talk about the potential headwinds, the long-term permanent impairment risks. What's the most significant fundamental threat to Domino's business model? The most significant long-term risk, in my view, is systemic franchisee deterioration.
Back to the franchisees.
Back to the franchisees. The entire Domino's model, as we've discussed, relies on the health and profitability of its independent franchisees. A confluence of persistent rising food and labor costs, coupled with the new fees charged by third-party aggregator partners, that could systematically crush franchisee profitability.
If they can't make money.
If franchisees can't make a decent profit, this could lead to widespread service degradation, slower deliveries, more incorrect orders, less attention to store cleanliness, and eventually store closures. This could become a death spiral for the brand's reputation, permanently impairing the business model.
A negative flywheel.
Exactly. And we've seen real-world examples of this risk manifesting. The recent leadership exodus and operational struggles at Domino's Pizza Enterprises, that separate listed entity in Australia-Europe, highlight just how fragile the system can become under sustained economic pressure on its operators. That's a stark warning.
That's a critical point because the health of the franchisee is directly tied to the health of the parent company's brand and financials. What else should we be vigilant about?
Another major risk is a brand-impairing event. Domino's value is inextricably linked to its globally recognized brand and the trust it has built. A large-scale food safety crisis, for example, widespread ingredient contamination.
Nightmare scenario.
Total nightmare. Or a major cybersecurity breach compromising millions of customers' data. That could cause irreparable damage to customer trust. We've seen how quickly such events can decimate a brand's reputation and its customer base. That intangible asset moat could just evaporate. Devastating for the business.
And the aggregators, while currently a growth driver, could also pose a long-term risk, couldn't they? It feels like a double-edged sword.
Absolutely. While currently a strategic growth driver, the long-term risk of partnering with aggregators is disintermediation.
Losing the direct customer link.
Exactly. If customers, over time, become more loyal to the Uber Eats or DoorDash platform rather than the Domino's brand itself, these powerful platforms could eventually dictate terms, demand higher commission fees, commoditize the product by making all restaurants seem interchangeable, and effectively erode Domino's direct customer relationship and profit margins. It's a calculated trade-off between short-term growth and the potential for long-term brand control and margin compression. They're leveraging the aggregators now, but the power dynamic could certainly shift over a long enough timeline.
So how does this detailed analysis stack up against what Wall Street is generally saying about Domino's? What's the typical market consensus, and does our deep dive align or diverge from it?
The current Wall Street consensus is typically a moderate buy. Cautiously optimistic, you could say.
Moderate buy. Okay.
The bullish view points to the new growth from the Uber partnership, the revamped loyalty program, the strong brand positioning as key catalysts for future growth. However, this optimism is tempered by a significant number of hold ratings. The more cautious or bearish views frequently cite concerns over slowing U.S. same-store sales, which have faced headwinds, intense competition in the QSR pizza market, and a valuation that, while attractive relative to its history, is still high in absolute terms compared to other industries.
So a mixed bag, really. Some bullish, some cautious.
Pretty much.
So our deep dive analysis, does it align with or diverge from that consensus? What's the second level thinking here, the unique insight we've uncovered that might be overlooked by the broader market?
Our analysis actually differs from the typical market consensus by placing a much heavier emphasis on the durability and profitability of the integrated supply chain as the true cornerstone of the economic moat.
Focus on the supply chain's deep value.
Exactly. The market, it appears, is largely focused on the more visible top-line growth drivers, the aggregator partnerships, loyalty program shifts, things like that. The contrarian view, which this deep dive leans into, is that the market is potentially underestimating the profound strategic importance of the boring logistics machine that underpins the entire enterprise.
That's a great point. The unsexy, behind-the-scenes stuff often gets overlooked, but it's often where the real durability lies.
Precisely. The aggregator partnership, while important, is not the strategy itself. It is a tactic to feed the true strategic asset, the scaled, low-cost production and delivery system.
Right. It fuels the machine.
It fuels the machine. The immense profitability and efficiency of the supply chain are what enable the entire model to function. It allows the company to support its high leverage, and it provides the crucial economic incentives, lower costs, profit sharing that keep franchisees tethered to the system, even through tough times. This structural advantage is more permanent and powerful than any single partnership, and its contribution to the company's long-term value creation appears to be underappreciated by the market's current narrative. Investors often chase the exciting growth stories, but the quiet operational excellence is what truly builds and sustains wealth in the long run.
Okay, this has been an incredible deep dive, peeling back so many layers of a company we all thought we knew. Let's synthesize everything into a concise investment thesis summary. What's the compelling bull case, the primary reasons to understand or potentially consider owning this company?
Okay, the bull case. Reasons to understand, potentially own. 4 powerful points. First, exceptional business economics. Capital light, high return franchise model, plus that scaled, integrated supply chain, leads to extraordinarily high and durable ROIC, consistently over 40%. Immense value creation.
If I returned.
Second, wide and widening moat, fortress-like competitive advantage. Dominant global brand, massive economies of scale, best-in-class proprietary tech platform. And it's gaining market share, proving its strength.
Check. Strong moat getting stronger.
Third, rational, owner-oriented management. Proven team, long-term vision, history of successful brand stewardship, disciplined, shareholder-friendly capital allocation, smart reinvestment, returning cash.
Check. Good leadership.
And finally, new growth vector at a fair price. Strategic entry into third-party aggregators provides clear path for incremental growth, customer acquisition. Yet the stock trades below its own historical valuation averages for this quality of business.
Check. Growth at a reasonable price relative to history. That's a very compelling argument for why Domino's is such a high-quality business. But what about the other side? For balance, what's the bear case, the counter thesis, or the key risks we need to consider before getting too comfortable?
The bear case also has 4 key points, warranting serious consideration. First, high financial leverage. That net debt EBITDA, around 5x. Manageable for stable business, yes, but significantly reduces financial flexibility and margin of safety if things go badly wrong.
Right. Less cushion.
Second, franchise system fragility. The whole model's health depends entirely on profitable, well-run franchisees. Mounting economic pressure, inflation, labor costs, aggregator fees could lead to systemic service degradation, brand erosion, unraveling the foundation.
The core risk, perhaps.
Arguably. Third, intense competition and disintermediation risk. QSR pizza is hyper-competitive. Growing power of aggregators, while a current growth driver, poses long-term strategic risk of commoditizing the brand, capturing customer relationships, eroding margins.
The aggregator double edge.
Exactly. And finally, brand reputation risk. Company's value is heavily concentrated in its brand. Major food safety incident, widespread service quality decline, significant data breach. Could cause permanent damage to customer trust and loyalty, undermining that intangible asset moat.
We've laid out the bull and bear cases in detail. Now, for our red team challenge, let's really push the envelope and invert the bull case. What's the primary misjudgment an investor could be making today if they buy into the bull thesis without enough skepticism?
Okay, the red team view. The primary bull thesis rests on enduring quality, stability, high returns, resilient moat.
Right.
However, the most compelling argument for why an investment today could become a major long-term mistake is that we are fundamentally misjudging the resilience of the franchise system at what could be a truly critical juncture.
Misjudging the franchise health under pressure.
Exactly. Imagine a failure scenario where a confluence of several persistent pressures, significant food cost inflation, outpacing pricing power, aggressive minimum wage hikes, squeezing labor margins, and those new aggregator commission fees permanently impairs franchise profitability. Not just a temporary squeeze, but a permanent structural shift.
Okay.
In this scenario, the franchisee who feels squeezed is no longer an isolated case, but becomes the overwhelming system-wide norm.
So the very foundation of their capital-light, growth-oriented model starts to crack from the inside. What would be the cascading negative effects of that kind of widespread financial distress among franchisees?
This financial distress would force rational, self-interested operators to cut corners in ways that directly impact the customer and the brand. They have to protect their bottom line.
Survival mode.
Reduce staffing, leading to consistently slower service, longer waits, more order errors. Defer essential store maintenance, leading to less appealing, less functional locations. This triggers a cascading wave of negative customer experiences far beyond the isolated complaints we see today.
It becomes systemic.
The brand's hard-won reputation for speed, reliability, consistency, the very essence of its value proposition starts to systematically erode. Same-store sales decline, not just due to temporary macro factors, but due to a fundamental structural decay in the product and service offering.
And at that point, the high corporate leverage, which we identified as a rational choice to magnify returns, becomes a crippling liability.
Precisely. The high corporate leverage, once a tool for enhancing shareholder returns, would become a crippling liability. It would prevent the parent company from having the financial capacity to provide the necessary support royalty relief, increased marketing funds, direct financial aid to its struggling franchisees.
They couldn't afford to bail them out.
They'd be in a bind, unable to sufficiently prop up the system. This self-reinforcing flywheel of growth and efficiency we described earlier, it violently reverses into a death spiral. The moat isn't breached by Pizza Hut or Papa John's. It crumbles from within as the very foundation of the franchise system erodes. The core competitive advantage, the robust supply chain, loses volume. Its efficiency declines, exacerbating the problem.
So for you, the listener, the provocative question at the end of this deep dive is this. When looking at a company like Domino's, are you truly buying a wonderful company at a fair price, counting on the proven stability and resilience of the past? Or are you potentially catching a falling knife, mistaking that historical stability for a potentially harsher and fundamentally altered future reality for the franchise system? It's a critical distinction.
Wow.
We've really gone from a simple pizza delivery to an incredibly complex and profound business study. Here's where it gets really interesting. We've seen how much more there is to this seemingly simple pizza business than meets the eye. The layers of strategic genius, the intricate financial engineering, the vital human elements from the CEO to the delivery driver, it's all there, shaping its enduring success or potential vulnerabilities.
If we connect this to the bigger picture, it really highlights how true understanding of any business goes far beyond the headlines, doesn't it?
Yeah.
It goes into its operational DNA, its historical choices, the incentives that drive every part of its ecosystem.
Yeah.
It emphasizes the immense value of understanding the underlying mechanics of a business, not just its product. Encourages critical thinking about how seemingly minor, often overlooked details like supply chain profit sharing or the granular economics of franchisee profitability can be the true drivers of long-term success, or indeed the hidden vulnerabilities that could unravel the entire story.
So as you think about any business, even the most familiar ones, how much attention do you really pay to the often overlooked boring parts of its operations? Logistics, supply chain integration, the health of its core partners like franchisees. Could those quiet, unsexy elements be the true indicators of enduring quality? Or perhaps hidden vulnerabilities you hadn't considered? It's a critical lens to apply.
It truly is. It's about looking beneath the surface, always.
Absolutely. So what does this all mean? It means there's always more to learn, and the deep dive continues. Thank you for joining us on this deep dive into Domino's Pizza. We look forward to exploring more fascinating companies and their hidden complexities with you next time.